Hello, chart watchers, and welcome to this Thursday, May 10th, Market Watchers Live Show with your hosts, Tom Boley and Aaron Swenlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. The bulls are at it again. We got the Dow Jones Industrial Average right now up nearly 200 points, with the Dow trying to break back up above that mid-April high. The S&P 500 also trying to break up above key gap and price resistance, currently up 21 points. The NASDAQ tacking on another 54 points, adding to yesterday's breakout above that April level. And the Russell 2000 up over 10 points today, trying to break to an all-time high and follow the S&P small cap index that did so yesterday. The 10-year Treasury yield down about 2.5 basis points today, but still hovering up in that 290 to 305 range, currently at 2.98%. Volatility index, this to me is a very bullish sign. We've got the VIX now down below 13. In the last two bear markets, we never saw the VIX fall below 16. I think this is a bullish sign. The healthcare industry is leading today, actually up 1.34%, doing well because medical supplies companies breaking out above recent highs, trying to close this gap from early May. Also, the health providers doing very well as well. And I'm going to show you a chart on this one in a little bit. This is a what I think could be a inverse right shoulder that just printed, but we'll talk about that in a bit. Technology continuing to power forward on the heels of the likes of Apple. Another beautiful move today in the XLK. ExxonMobil helping the energy. Of course, this represents about 23% of the XLE, and we are getting a breakout in ExxonMobil today. Finally, Booking Holdings, formerly Priceline, reported earnings on the other end of the spectrum, down $120. Keep in mind, we've talked about this plenty here on the show, from a seasonal perspective, Booking Holdings or Priceline tends to do really well in the first 4 months of the year. But once we get past April, they do tend to struggle. I would watch this price support level very closely. And with that, let me bring in my co-host, Aaron. How's it going today, Aaron?
I'm doing great. It is going quite well. I'm very excited for today's show. We had a lot of fun preparing today.
Yeah, we always have fun preparing. And of course, we got a great guest on here today. Dan Russo is with us. He is Chief Investment Strategist with Chaikin Analytics. And how are you doing this morning, Dan?
I'm doing really well, thanks. Happy to be here. Thanks for having me.
Yeah, we got some big announcements we're going to let you talk about here in about 15 minutes or so. So stick around and we're going to bring you back if that's okay.
That's great. Looking forward to it.
Awesome. Well, we got a lot to go over, Aaron. So I think I'm just going to let you take it away with the announcements and the agenda, and let's get this thing going.
Absolutely. So for our weekly schedule, everything stock charts is going to be tomorrow. And then I have my workshop on Tuesday. I'm still looking for a topic. Right now, I'm kind of leaning toward trade plans or trading plans, sort of go through what I do to, before I make a trade. So I'm kind of leaning that direction. I think everybody else might like that. Dan Russo, you're going to be here for a longer visit on Wednesday of next week. So that'll be a lot of fun. And then we have on Thursday, Julius de Kempener. He is going to do the RRG and talk to us more about that. I can't wait. Today's agenda, though. What are we going to do today? Like we said, we just introduced him, Dan Russo from Chaikin Analytics. And then our new segment coming up, which is called, Are You Buying This? We won't explain it until later. 10 and 10 to 1. We have our first symbol is going to be Johnson & Johnson, JNJ. So we'll want to you'll be interested in that one, I think. Scooter Report will finish off the day. And with that, I think it's time for that technical news and headlines. And yes, let's get started. We have quite a bit to cover.
Sounds good. Let's take a look here. We did have a couple of economic reports out, so I'll go through those with you as we take a look at the 10-year Treasury yield. You can see that after breaking out above that prior high at 2.94% back in February, we have simply been consolidating above this rising 20-day EMA. So I think the yield continues to show very bullish characteristics, meaning that that's bearish for bonds. It's bearish for treasuries as yields move up as bond prices move lower. But as far as the economic news out this morning, initial jobless claims again came in better than expected, 211,000 versus the 220,000 that was expected. Also, for those who maybe were looking for higher inflation, we didn't get that. April CPI came in this morning with a rise of 0.2%, market looking for a rise of 0.3%, and the core CPI rose just 0.1%, and the market was looking for a rise of 0.2%. So overall, I think the action, the economic news and so forth has been very positive for equities and very bearish, I would say, for the bonds and for the bond market. And that is, for the most part, what we've been seeing as the yields continue to rise. Now, I wanted to go through a couple of things that we were just taking a look at a minute ago when we looked at the open, or looked at our opening update, I should say. Healthcare. The XLV has really been struggling off of the January high, continuing to put in lower highs and really equal lows, continuing to hold that low from back in February where we got down around that 79 area. So I would certainly keep that in mind. But I do believe if we're moving more into the next phase, that next leg of the bull market, that tends to take just about everything with it. And so I'm starting to look for some of these groups that have been underperforming to begin to perform a little bit better. We're seeing that here with the XLV as we have broken back up, trying to get back through the 20-day moving average. As I talk about a lot, you know, when you're consolidating, I don't really pay much attention to these moving averages. But when you get above the moving averages, if you start to see that moving average holding as you break the new highs, that can be very bullish. We've seen it in some areas, and we'll be watching to see if the XLV, if we move that way in terms of the healthcare sector. A couple of the areas, though, that mentioned at the top of the show within healthcare. First, we've got the medical supplies doing very well today. You can see also along with the XLV, though, we've been trending lower here in the medical supplies index. But I think a breakout above this 897 area would be very bullish for the medical supplies, something to keep in mind. I think a more bullish industry group within healthcare, though, is the healthcare providers. This chart to me, and I'm going to stretch this out, this is a 6-month chart, but I'm going to go out a year because I am seeing a pretty solid inverse head and shoulder pattern that a breakout above 1850 would really confirm. So what I'm looking at here is the neckline coming across at about 1840 or so. I could annotate this for you if you are not familiar with these patterns. But what I would be looking at here is a left shoulder over here. And then down below that, when you go to your next low, that would be the head. So you got the head down here. And then possibly the low that we just saw could be putting in the right shoulder, could have put in the right shoulder, I should say. So what I'm looking at here is a possible right shoulder. So off of an uptrend, this is what you look for. And this is what we talked about back in January. I know it gets very frustrating because you wait for months and months to finally start to see some breakouts of these patterns. But we had a huge move to the upside, and these consolidation patterns take time. Here we pulled back, established what I think is now the left shoulder. The reaction move to the upside sets the left side of the neckline. We come back down to a lower low. That puts in the head. We move all the way back up to in my opinion, I like to get the equal high or even a higher high to make the neckline upsloping. To me, that just carries a little bit more bullish implications with it. We did put in a reversing candle there, as you can see, right at the neckline, pulled back one more time. I think putting in a right shoulder fairly close to the left shoulder and now starting to make a move to the upside. Healthcare providers on a breakout above 1840 would measure from 1840 down to about 1680. That's 160 points and takes us to 2000, just a little bit above the high back in January. I'm not saying we would top there, but there is your pattern measurement on the healthcare providers index. So I think this, even the groups that have been lagging still are in what I consider to be bullish consolidation patterns, bullish continuation patterns, if you will. And so we've seen it even with the Dow and the S&P. I think we continue to see a pretty good action. It's just that they've underperformed because of that rising dollar that we've talked about a lot on the show. But if we pull up the Dow Jones, you can see we're making what could be a breakout of a descending triangle. I'm going to go back a little further on this chart as well. But I see an uptrend, clear uptrend. And if we annotate this, let's try this again. All right, so with a pattern, I typically like to use the black line. I mean, we could do that. Now you could draw there, but obviously that isn't really helping. But if we take the bottom here, the bottoms coming across, I think pretty clearly are at that 23.5 level. I'm going to use this because, first of all, I think if it's a combination of things that you want to see when you break out of a triangle, you should take out that prior high. So if I had drawn this line back here, the problem with that is when you finally do make the breakout here, you don't take out the prior high. You simply go right back down and move all the way back down to the low. So I don't think that's the appropriate line to draw. Instead, what I would be looking at is this right here. And can we now take out that mid-April high? If we do, I think this is a bullish development. I would draw that line in here as well, right about that level. So you can see the Dow getting very close to making that breakout as we speak. But very, very bullish action, even in areas that are lagging the market. I still see triangles. I see inverse head and shoulders. I see these different continuation patterns that eventually I think are going to result in bullish breakouts. And we are seeing that across some of the areas as well. Now, I mentioned the health providers. One of the stocks I think looks really interesting. Talked about this. This stock tends to do very well in May. It is one of the better seasonal stocks in May within the Dow Jones. And we came back down. We just filled this gap. This was an earnings gap higher. Came all the way back down, just filled the gap and starting to turn back up. I think United Health looks very interesting. And if we pull it up on that relative chart that I like to look at, you can see that while the health care providers has been moving lower, UNH isn't too far from that breakout. And that is reflected in the relative chart of UNH versus the healthcare providers. So I think we've got a top stock in a group that is showing an inverse head and shoulder pattern, which is a bullish pattern. So if you get one of the better stocks in a group that is in a bullish pattern, I think that in time you will do pretty well. So I like UNH. We'll see whether or not we can hold. I'd probably use maybe that 50-day moving average as an area for a stop, but I'm looking for UNH to go back up to the 250 level and challenge that January high. Now, I talked a lot about small caps and how they've been outperforming, and I expect that to continue. I don't know that it'll continue uninterrupted, but I do expect it to continue. And so what I wanted to do is take a look at some individual stocks, smaller stocks that reported earnings, and give you some ideas perhaps for some potential trades as we move forward. WMGI, this is Wright Medical Group. Big move up today after earnings. They beat on the top line, $198.5 million in revenues. The Wall Street consensus estimates was 193.5, so nice beat. Bottom line, they lost a penny, but the market had them losing 7 cents, so a much better than expected report there. And if you take a look, this is in the medical equipment area, which is nearing a breakout. And all of a sudden, off of a downtrend, this was a stock that had been underperforming for a while, but now look at this move to the upside with a solid earnings report and a solid group. This could be the start of some relative strength in WMGI. Let's pull up another stock. This is RNG, which is Ring Central. Beautiful breakout here. Now, this is a little bit different because the group itself has been recently breaking to 6-7 week lows, but the stock is breaking up to a new high. So in this case, what you have is a stock that's been clearly outperforming the group, and a group that has really been struggling over the past 5 weeks or so relative to the S&P 500. So this is kind of a flip. We got a group that's not doing so well, but a stock that's doing incredibly well. So if we could start to see some strength in I think this is computer services, I believe we would get, this would line up a lot better if it was in a strengthening group, something to watch. Green Dot, GDOT, this stock is absolutely on fire today after earnings. They blew out top line, blew out bottom line. And you can see this is a company that went sideways for quite some time and is just making the breakout. And take a look down here. We're getting an industry group that's also making a breakout. And quickly, this is a stock that's trying to lead its industry group back to the upside with the breakout on earnings. So this is one that I certainly will be keeping my eye on. Its peers have been outperforming the S&P 500 for quite some time. I think the stock looks really good here. Now, it is up 15% today. I don't like to chase these stocks, but this stock would be one on my watch list, and maybe it'll settle down over the next couple of weeks and provide a nice entry point as we go forward. A couple of renewable energy stocks that posted results, really strong results and nice reactions. Sunrun, RUN, big gap up here, taking out prior resistance. You can look down below here. You can see very solid volume coming in on this move to the upside. And renewable energy making another move up, trying to make a breakout. So if you could get a breakout there, you got a stock now that has been rising over the past few months. Keep in mind, again, it's a small company. Many of these small companies are beginning to outperform, and that is the case with RUN. It has certainly been on a run, not only versus its peers, but also, as you can see, relative to the S&P 500. Another stock within this space is SEDG, which is Solar Edge. Another breakout after consolidation here. Again, this is the renewable energy space. This stock has already broken out, though, relative to its peers. Looks to be one of the stronger stocks in this space as we speak. Another company I'm going to mention, this one, if it had more volume, I'd be more interested in it. ICUI, this is in ICU Medical. Nice little cup and handle off of an uptrend. Here's your uptrend, nice little cup. Pull back, handle to the 50-day, and then we break out with earnings. But you can see the volume tends to be under 100,000 shares a lot of days. And I'm a little, I don't know, maybe a little allergic to illiquid stocks. I don't like to trade them. So I would pass, but I do like the pattern. And these are the types of things that I would look for. Uptrending stock, sideways consolidation, this cup with handle, this is a continuation pattern, and a breakout on increasing volume. This would measure up about 25 points, top of the cup down to the bottom of the cup, which would take the stock to about 290. That would be a target on the stock. Now, again, you're in medical supplies, which has been lagging, but starting to show some strength, as we talked about earlier. But clearly, this has been one of the better looking stocks within medical supplies. All right, one other stock I want to mention, and then we're going to bring in Dan Russo, our special guest. Last stock, EVH. This is another company, reported much better than expected earnings and revenues, $144.4 million in revenues. The market was looking for 141. And then at the bottom line, it came in with a profit of 2 cents. The market was looking for a loss of 4 cents. So they did turn profitable. Here's a company that sold off really heavy back in early November, struggled, but made our way all the way back to this area at 17, which after that selling, that was the top. That intraday move right there went to 17, pulled back. We made our way all the way back to 17, and now with earnings and revenues better than expected, we're getting a breakout. And again, that money is rotating toward these smaller companies. And by the way, this happens to be in the software space, which has been one of the best areas of the market for many months. And so you've got a great area of the market, a stock just making a breakout, and therefore just starting to show some nice relative strength. EVH is at its highest level relative to the software index in about the last 5 or 6 months. So I think EVH looking very, very bullish to me on this breakout. So pull back to that 17 area. That was serving as resistance for a while, but broken resistance does become price support, and that's what I would look for on a pullback on EVH. And with that, I am going to bring in our special guest, Dan Russo. He is Chief Investment Strategist with Chaikin Analytics. We had your partner and good friend, Mark Chaikin, on not that long ago. A very interesting conversation.
I'm sure it was.
Yeah, and I know you've got a great announcement for everybody listening to the show. So I'm going to let you talk a little bit about your upcoming show.
Yeah, well, Tom, thank you so much. And thank you, Aaron. I appreciate you both having me on. So starting tomorrow at 9:15 a.m., right before the market opens, we're going to be introducing Chaikin Power Feed TV. Chaikin Power Feed is a daily email that subscribers can receive. And you get stock ideas, a quick snapshot of the market, which sectors are outperforming, which sectors are underperforming, and who's on tap for earnings, the previous day's big earnings surprises, both hits and misses. So that's a free email that comes to you every day. And then this show is going to be me kind of highlighting the content that's in that email, as well as augmenting it with some themes that I'm looking at as the chief market strategist at Chaikin Analytics. And, I brought a few of those today and happy to go through them or answer any questions.
Yeah, absolutely. Take it away. We got your screen up, so you're good to go.
Perfect. So I start off every day with kind of like looking at a short-term chart of the S&P 500 just to highlight some of the key support and resistance levels. And obviously, this was as of this morning. We are strong today. We took out this 1710 level has been key for me. These were the April highs. Tom, you referenced them in your introduction. And kind of like my message for the past, we were talking about this earlier, it's getting a little long in the tooth and finally starting to play out. My message has been that this entire consolidation has been a consolidation within the context of a secular uptrend. The 200-day moving average, which is this green line here, has served as support, during the entire consolidation, really. So my view has been, consolidation in a secular uptrend. And lately, I've been saying, look, you want to see the S&P take out 2710 to the upside and ideally 2741 if you're bullish, to give you conviction that the secular uptrend is in fact resuming. So assuming we hold today, hopefully we can turn this resistance line green and call 2710 support going forward. But so this is kind of what we highlight early on. I look at momentum. I look at RSI. I know you look at a few indicators based on your charts as well. RSI kind of working to new highs as the market works higher gives me a momentum confirmation. I don't just kind of blindly use the 70 is overbought, 30 is oversold, take the other side mentality. I use it more for confirmation of what we're seeing in price. So then, this is something that our subscribers would receive if they sign up for Power Feed TV, kind of a quick snapshot of what's going on in the morning. And then we have proprietary IP. We call this our Chaikin Power Bars. And in Chaikin Analytics, we rank stocks, all the U.S. listed stocks and ADRs. We rank them either very bullish, neutral, bearish, or very bearish. And the Power Bars give you a quick snapshot of an index or an ETF, how their constituents look based on those rankings, right? So the Dow currently has 7 stocks that are either very bullish or bullish, 14 that are neutral, and 8 that are either very bearish or bearish. So the S&P, I'm assuming this is going to change today. It's been improving all week, but the S&P as of this morning was still skewed to the negative side. The NASDAQ slight positive. You were talking about small caps. That's been a big theme for me as well. Small cap outperformance is something that I think is going to continue, and you can see it here in our power bars, right? 442 bullish or very bullish for 336 bearish or very bearish. Obviously, oil's been hot, so energy outperforming. Every day we have a stock of the day. Today's stock of the day was Fortinet, and on the show I'll kind of rip the chart apart and tell you why it was a compelling long idea or a short idea or why you should wait. But I'll go through some of the proprietary analytics that we have to kind of walk you through why I think it's a compelling idea. Like I said, sector movement over the last 5 days. Tech's really been outperforming for the past week and a half. Apple really got the tech sector back into gear with their print early last week. And we want to see that because was Apple 26% of the S&P. We need tech to be strong if we're bullish. Utilities underperforming, not a surprise considering the backup in rates. Every day we'll give you an industry in focus. Sometimes it's a good one, sometimes it's a bad one. Today's it's a bad one. Pharma services. I mean, you were calling out healthcare providers. That's been great. Med tech's been great. Pharma has been an absolute disaster. You can see it here. Our IP shows you that the group is skewed 3-1 to the bearish side. And here are some indicative names. And then, on the show, I'll take you through one of them. Like this Airy, we rate it with a very bearish rating. It's a weak stock in a weak industry. It's been underperforming the S&P 500. Our proprietary money flow indicator, created by Mark Chaikin, has been bearish. That's a sign of institutional selling. The only thing that gives me pause right now to open a short position in this stock is the fact that it is in fact oversold. But all else remaining equal, if we're still below this long-term trend line and this indicator gets back to overbought, Airy is a name that looks compelling as a short idea. It's one that I put on a bearish watch list this morning. As I said, we can walk through earnings, who beat, who missed, some of the upcoming earnings. So today after the bell, the big one that everybody will be watching is NVIDIA. We want to see semis do well as part of the tech sector. Semis have been leadership. NVIDIA is a high-profile name in that group. We want to see a strong print and a strong response from the stock tomorrow. And then every week for Chaikin Analytics subscribers, in my morning note, I kind of walk through a theme. The Thursday theme is market breadth. Here's the advanced decline line for the S&P 500, going out at all-time highs yesterday, confirming the strength we're seeing here, kind of confirming the fact. What's interesting to me is this uptrend never broke. So even as the market was consolidating, this uptrend never broke. And this was a big part of giving me the conviction that what we were seeing was just a consolidation within a secular uptrend. And then I like to look at kind of thematics. Today's theme was mobile payments. There's an ETF called ticker symbol is IPay, IPAY. Mobile payments not going away. You pulled up Green Dot before. That's part of fintech. So call it fintech, mobile payments. If I was looking for long ideas to play that theme, I'd kind of look at the holdings of iPay. One of the names that I highlighted bullishly was American Express. So it's an interesting product. It's free. You can sign up, chaikinanalytics.com/PowerFeedTV. The show will be for 15 minutes. I'll kind of walk you through my high-level thoughts on what you're seeing in PowerFeed as well as what's going on in the market. So I'm happy to open it up to questions from you guys.
All right, sounds good. I don't know if you have some there, Aaron, in the chat room.
No, when Dan Russo speaks, everybody listens.
Well, that's good. We like that.
It's definitely a good thing. Well, I got a question for you, Dan.
Sure thing.
And I'm going to go ahead and pull the screen up. I'll take the screen and show you a chart that I've done, and you may appreciate this. Everybody who's in here is probably like, oh no, not this one again. He's But I think this is really important. And the top part of this chart, it's the U.S. Treasury yields, the 10-year Treasury yield minus Germany. So we see how our Treasury yields here are faring versus foreign Treasury yields, particularly in Germany. And we can see that throughout this bull market, for the most part, this has been an uptrend. I mean, we've had periods where we pulled back for a while. But when I looked at this, it makes sense to me that when our Treasury yields are going up faster than foreign Treasury yields, our dollar should rise. And at the bottom of this chart, that's kind of what this correlation shows, is that the two do tend to move together. It's not a perfect correlation. If that was a perfect correlation, we'd see this sitting at +1 all the time. So you can see,
of course.
Yeah, there's definitely moves back and forth. But I wanted to point out 3 times in particular, and that is back in 2009, where yields were moving up in the U.S. faster than Germany, and the dollar went the other way. Same thing again in 2013 into 2014, with the dollar going the other way. And then finally, more recently, the 10-year Treasury yield here in the U.S. has been absolutely flying to the upside relative to Germany. And yet, for about 6-7 months, we saw the dollar continuing to fall. Now, we hit what I thought was a major price support level on the dollar index around 88, also trend line support around 88. And Aaron had been calling for a rising dollar. And based on this chart, I was looking for the same thing, because the last 2 times we saw this disconnect, you can see the inverse correlation that developed. We just got the third one that got to this level. And in each one of those cases, I'm going to bring up the next chart, which shows the small caps at the bottom and how they perform relative to the S&P 500. We got, after these negative inverse correlations, we had a huge move to the upside in the Russell 2000 relative to the S&P 500. We're starting it again. And in both situations, we had the dollar play catch up in a hurry. And I think this is just starting. So I'd like your comment. I mean, do you think the dollar is going to continue to strengthen? And if so, would you continue to wait toward those small cap companies?
The answer is yes to both of those. As far as I'm concerned, it's actually, I mean, you're talking about it here. It's been a theme that I've been talking about for a few weeks. My strategy has been to be overweight small caps relative to large caps. And really, there were 2 drivers of that. Number one, what you're touching on here, a strengthening dollar. And number 2 was, trade tension, concerns about trade tensions, with China. Both of those for the same reason, right? You want to favor small caps because they receive less of their revenue overseas relative to large caps. So my thesis has been small over large for those 2 reasons. What's interesting is how bearish everybody was US dollar coming into the year. And in fairness, myself included, at the end of last year, I was bearish on the dollar, but kind of like you, I said, listen, if we don't take out this kind of 87.5, 88 level on the dollar index, then we probably work higher. But I was bearish. That trade got crowded. It's been the right move to reverse course, and I think the short dollar trade is unwinding. I don't get the impression that it's crowded on the long side yet, but it's certainly something we're going to keep an eye on. I expect dollar strength to continue, small cap outperformance to continue.
Yeah, I think too. I just pulled up this chart on the S&P 600 small cap index, and it looks like a pretty nice ascending triangle that has printed over the past few months during this consolidation. And while we've got the S&P 500 still meandering in the middle of its consolidation zone, and we could debate back and forth whether or not we're getting a breakout, not getting a breakout, and so forth, I think it's pretty clear on a relative basis the money's been rotating here into the small cap stocks.
Money has been rotating there. And that's what you want to see too, because it's a sign of risk taking as far as I'm concerned. I mean, not only do I use small caps, just look at it on an absolute basis, but the relative outperformance kind of gives you a breadth indicator as well, right? Mm-hmm. Something you want to see. For a long time, the big knock on the market through, if people who were trying to be bearish on the market in 2017 pointed out that the only reason the S&P 500 was going higher was because of the FANG, and it was, then it became the FANG plus Microsoft and NVIDIA or what have you. But the gist of it was, less than 10 stocks were driving all the outperformance in the market. So, and you could see it here. I mean, through 2017, if you pull up a longer term chart, like the small caps underperform large. Now the fact that small caps are outperforming large, that to me is a sign that it's not just the what I like to call the generals. I call the FANG stocks the generals. Yeah, there it is right there. 2017, small caps underperform relative to large. 2018, that trend is reversing. To me, that's another breadth indicator. More stocks are joining the rally than just Amazon and Apple and Facebook and Google and Netflix. And if you want to throw Microsoft and NVIDIA in there, throw them in as well. The point is, it's not just 10 stocks taking the market higher anymore. Your performance is broadening, strength is broadening. That's bullish for the market. That advanced decline line that I showed you in my presentation going out at all-time highs yesterday, that's bullish.
Mm-hmm. Yeah, I added onto this chart the dollar at the bottom, the dollar index, so that our audience can see this underperformance that we saw in small caps throughout 2017 coincided with a falling dollar. The dollar fell 14% during 2017, and I don't know if a lot of folks realize that, but that was a pretty steep drop in the dollar. And of course, when the dollar's declining like that, those multinationals on the S&P 500 are benefiting from foreign currency translations on all the work that they're doing in China and other parts of the world. As you mentioned earlier, Dan, the small caps don't get that benefit. But now with the tables turning and starting to see this dollar rise to the upside, you can see what's happening. Money is now shifting back more toward those small caps.
Yeah, no, and I think that's right. And I do want to highlight, though, that it's not necessarily just because you're seeing the dollar strengthen. I don't think you blindly go out and buy small caps and short large caps, just because you have to think about it. Take the analysis a step further. A large company, take a company like an Apple or a GE or a large multinational company. They're not just sitting there and letting a strong dollar work against them, right? They have very, very sophisticated treasury departments, very, very sophisticated hedging programs, right? So I don't think it's right to go out and just take this and say, oh, well, the dollar's going up, so we want to be long small caps and short large caps. I'm just saying small caps are probably going to go up more than large caps. I think the market's going to work higher and small caps are going to outperform. This is not a short call on large cap stocks.
Right. Oh, no, I completely agree. I think that the outperformance, though, that we saw could get reversed a little bit longer here in 2018.
I think that's exactly the message, right? That's been my call is, as the market goes up, small caps are going to go up faster than large caps.
Yeah, as long as the dollar keeps rising, at least in my opinion. I think I agree with you. There's a lot of things that go into it, but certainly a rising dollar will provide some tailwinds for the small caps simply because they don't get it. They're not impacted as much bottom line by a rising dollar.
That's exactly how I'm viewing it.
So we have a lot of people, of course, you've now piqued everybody's interest. They all want to know when and where they can watch this show that you're going to be doing.
So Monday through Friday at 9:15 on Stock Charts TV.
Woo! Well, it'll be great to have you.
Yeah, it's fun. I'm looking forward to it. It'll be educational. Like I said, folks can sign up for PowerFeed by going to chaikinanalytics.com/PowerFeed TV, which would be good because a lot of what's going to be on my show and what I'll be showing on the screen, you'll have at your disposal, right? You'll receive that email prior to the show airing, so you'll be able to follow along, and I'll be able to, kind of assume that you know what I'm talking about, and you're not just listening and you haven't seen the information yet, which will be helpful. And then, and then I add in things that I think are interesting or thematic. For instance, the market breadth today, the advanced decline line going out at all-time highs. I mean, that was really interesting to me. So we'll talk about things like that. So by watching the show, you'll get a lot more than what you get in the email, but the email will be helpful when you're watching the show.
Absolutely. Very interesting. I think it's awesome that we've got a show like that that's going to be right before the market opens. I think all of our listeners should tune in, get some great trading ideas, some thematic ideas of what's taking place in the market. We're really looking forward to your show, Dan.
Yeah, I'm looking forward to it too. And like you said, every day you do get a stock idea, and I'll kind of rip it apart for you.
Yeah, absolutely. And you're going to come back and join us next week, correct?
I am going to come back next Wednesday, I believe.
Awesome. Well, we look forward to having you back. It's been fun chatting with you.
It's been great. Thank you.
Yeah, look forward to hearing from you every morning, no doubt.
Awesome.
All right. Thanks, Dan.
Thank you so much, Tom. Thank you so much, Aaron. Have a great day.
Very welcome.
All right. There he goes. That is exciting news for Stock Charts TV because we do need that morning presence. And as you could, hear from Dan, very enthusiastic, been doing this for a long time, works with Mark Chaikin at Chaikin Analytics. And I think that the message that he had today was very strong, very bullish. That doesn't mean you have to agree with him. I've been bullish. You don't have to agree with me. You can come up with your own ideas, but I do think that Dan will be able to provide some great commentary right before the market opens. So please be sure to check that out.
Indeed. It's great. We're just expanding our schedule and shows consistently and constantly. So it's Stock Charts TV just continues to be better and better, I would say. And oh my gosh, it's free. So.
Yep. And I did go into Stock Charts TV page, and under the schedule down here, I did highlight, it says 9 a.m. I'm not quite sure if it's 9 a.m., 9:15, but.
Oh, they're going to be moving it to 9:15.
Okay. Definitely check that out for sure, because I think, again, it could give you some nice trading ideas each morning before the market opens.
Absolutely.
All right. So what do we got up next? I think it's a new segment, right?
Yes, it is a new segment. It is called, Are You Buying This? And I'll let you explain the premise as I get my questions ready for you.
All right. Well, if you've been around for the sound off segment before, it's kind of a little bit like that, except we're not going to limit time on responses. And it's just me and Aaron. I think with sound off, we've always had a guest on. But what we're going to do is just talk about a stock, an index, something that has piqued our interest. And we're going to take a position on it one way or the other. And we're going to ask the other one, are you buying this? Maybe not literally buying it, as in going to your broker and buying the stock, but are you buying the argument?
Right.
So I think it'll be fun. So I can start it if you want.
Sure. I think you have the screen right now. So let's do this.
All right. Let me go ahead, and I am going to pull up the volatility index and start this thing off. You can see right now it's just over 13. It's down another 3% today. It was down, 7 or 8% yesterday. And I'm going to pull up a long-term chart on the VIX here because, I've been bullish. I have not swayed much in my bullish beliefs. I didn't want to see the S&P lose 2581, and we haven't lost that. And I'm starting to see some bullish things happen. One of the things I'm seeing is this volatility index. Now, I wanted to go back and point out, and I want to go back even a little bit further. I know there's a lot of stuff on this chart, but during the bear market in 2000 to 2002, we never saw the VIX fall below 17. In the bear market of 2007, once we saw the VIX spike in 2007, during that bear market, we never saw the VIX go below 16. So 16 to 17 has kind of been a floor for the VIX during a bear market. Now, I know there's been a lot of discussion. There's been a lot of sides being taken on, are we just correcting in a bull market, or are we topping in what's going to be a bear market? I think that the volatility index moving back down to 13 is confirmation to me, based on the last two bear markets, that we are no longer threatened by a potential bear market. So are you buying that, Erin?
Well, I'm going to say a little bit of both. I know. See, that's the beauty of this. And now we don't have to get cut off. So let me go ahead. I'm going to take the screen and let's get to this one. And what I want to show you my VIX chart. So I agree that, the levels of the values themselves, I get that. But I really, for me, when I'm watching this, I'm not necessarily too wrapped up in the actual readings. I'm just really more interested in those tops and bottoms and what generally follows. And so for me, I look at the VIX as sentiment, as I know you do as well. In the very short term, I find that the very low readings can lead to downtrends. Now, we're talking about going into a bear market or not based on the VIX. And I'm not, I've never, raised my hand and said, yes, we're going into a bear market. This is a bear market. But I have certainly been more bearish than you have. So I like the fact that we do have these low readings, but, I don't know that the readings are quite as important as far as the actual readings. At least that's just how I look at it. I like to look at tops and bottoms on the VIX. So I'm showing you this. This is my breadth chart. And some of you have seen this. I talk about this one fairly regularly, but I have an inverted VIX with Bollinger Bands. And so the lower the reading, you're going to get those penetrations of the upper Bollinger Band. So I'm just going to show you, let's make this more of let's get rid of some of those really low readings or high readings so that we can get, let me see. Yes, so we can see just a little bit better. So what I'm pointing out is that, when you get the VIX very high, that means fear, right? But what tends to happen when you get these high readings? You start getting the rally off of that. At least when I'm looking at this is inverted. We got really close to the top. People were very complacent, and we went into a downtrend. Again, here's people were starting to get very fearful, sentiment being contrarian. We saw consolidation off of that, but we eventually started to look at an uptrend, and we'd been staying below that average the whole time. So I don't want to get too far into this, but I would say I'm buying it as far as the bear market is concerned. I do see your point, but I also wanted to point out that for me, the VIX can also be used as a contrarian indicator. So just because we're seeing these very, very low VIX readings, that could be something that would lead into, a decline because of the contrarian factor. I have to say right now, though, I wrote about it yesterday. I'm feeling a lot better about the market. But as I've said previously, a couple days of rally does not a bull market make either. So we'll have to see.
Okay. What do you got?
All right. Let's sort of in the same vein. Let's see. I have it right here. So again, I look at climactic readings, and that's sort of my thing. So this is the new highs and new lows, and then the 10-day moving average of the high-low differential. And notice when we get these really big spikes and new highs, that means everything's going great in the market. What tends to happen after that? We see consolidation, we see a decline, there's more consolidation. Look back here in August of 2017, we got the decline off of that. Now I marked these green because obviously it doesn't always work, or else we'd all be rich. But, we had these spikes and new highs. So I know that we're not talking about this level right now, but we are looking in the levels that we've had this year. And as far as that, we're seeing a spike. And the last 3 spikes came at the market tops. So does it concern you at all that we're seeing, a plethora of, these new highs are building? And as you can see, when we kind of max out, we tend to see a top.
Well, okay, good chart, good point. I'm going to say that it does not concern me, that I'm not going to buy into it because number one, we've been consolidating for the last 3 months, which is something completely different than what we saw in 2017. We had a market that went up. The S&P, I think, for a record number of days, never saw a 3% decline. So it was a completely different market than what we've seen recently. And the consolidation that we've had since January, I think personally has played out. We've been able to hold on to the support level, and we're starting to see breakouts in some key areas of the market. And so for me, the S&P new highs here is a little bit of a lagging kind of an indicator. And I think as the market continues to strengthen, you're going to see those new highs rally to the upside. And throughout 2017, I mean, when you look at those peaks, they continued to build throughout the year. I mean, the numbers kept getting higher and higher as you were making breakouts, and that's what I would expect. I think the reason that they're so low in 2018 is simply because we haven't had many stocks breaking out to new highs, but I think that number is going to start to expand based on the break of some of these consolidation patterns that we're seeing in the market.
Nice. I'd like to see some more new lows to get me really a little bit more excited about a breakout, because again, you can see those spikes, climactic readings. So, All right. What do you got for me?
All right, let's do another one. I would like to look at what can we? I already talked. I was going to talk a little bit about the U.S. Treasury yields, but we just had a pretty lengthy discussion with Dan Russo, so I'm not going to go there. But I'm going to go with. Let me see. I think what I'll do here is. All right, I got my next one.
Okay.
I got my next one. Okay, here's a chart of the railroads going back over the last 6 months. Now, railroads, by their nature, really reflect what's going on in the U.S. or in North America anyway. As far as I know, we don't have any railroads connecting Asia to the U.S. or Europe. I mean, we're talking about shipping goods in North America. I believe this is another confirming sign that the U.S. economy is strong and expected to continue to strengthen as we see the railroads breaking out to highs above what we saw back in January. So again, we've talked about a number of areas where the market has struggled, but there are areas where we're beginning to see some really bullish action. And I think the railroads are one of those where we made a huge move here over the last week. We've cleared, yesterday we cleared what I thought was very significant resistance at about 1900. We moved up easily through that, and now we're breaking out to a new high on the railroads. PPO pointing up. I believe this is another signal of a continuing bull market. What say you? Do you buy into this?
You know what? I absolutely do buy into this. This is one of the reasons I'm feeling a little bit better about the markets as of late. My indicators have turned a lot more positive. I think it would be, I think Dow theory is part of it. But, when you see the transports doing well, that means goods are being bought, goods are being shipped and moved around. And that's telling you that, yes, the economy is good. You should expect the market to start doing well if it isn't already. So, and I'm looking at this chart and I kind of see an ascending triangle that shaped up with the breakout that happened yesterday. So I definitely buy that. I would have certainly come in at the same way you did on that question.
Awesome. All right.
I've got one more for you.
We're going to make it quick.
It's a quick one.
Okay.
All right. People keep saying, we've been bad mouthing GE for so long. And so I wanted to look at the chart and I wanted to see if you were in the mood to badmouth it, because actually I'm thinking this might be an opportunity. We've seen we've been pretty much dogging GE for quite some time. And a lot of people said, hey, we hit that April bottom. You kind of missed that. I didn't see anything really strong at that point, but we've now broken above the 20-day EMA. And you can see we haven't had a sustained move above the 20. We came down, tested it, and now are heading higher. I've got reverse head and shoulders on tap here. And I know some people who follow me will say, oh, wait, but that PMO is really overbought. If you just go in and make this more of like a 5-6 year chart, you can see the range that the PMO typically trades in, and we're just above zero. We haven't even come close to overbought territory. We're sitting in neutral. So I think there's plenty of upside. Oh gosh, look at that. Even the OBV is broken out above that declining trend line. So what say you?
Okay, I believe the GE chart is much better than it has been for a long time. I think it's still got a little bit of proving to do. I mean, I think there's still some confirmation that I would look for. I'm going to go ahead and take the chart because I want to show both the daily and the weekly chart and how the numbers kind of come in together here. I think GE, first of all, I agree with you. I think that this is a potential bottoming head and shoulder pattern, reverse head and shoulder pattern, which is very bullish if we get the breakout. I think volume trends have turned much more bullish. So there are some real positives here. I'm going to draw this line in here at about 1530 to connect this high on what could be the left side of a neckline. I mean, technically, we would draw a slightly declining neckline, which I'm not a big fan of. I would much rather the right side be higher than the left side and have upsloping. But given everything GE's been through, volume trends certainly appear to be strengthening now. We pulled back, held on to gap support in the moving averages, started to turn back up. So on the daily chart, I agree. I think things are really starting to look bullish, and a breakout above 1530 would confirm that. On the weekly chart, it's amazing, but the key level is really the same 1530 area that I'm watching. So on a weekly chart, now you look at this chart and you say, wow, this is just a ski slope. And, we're getting a little bit of bounce like we did before and really nothing significant. Well, notice that since GE's decline, the PPO is continually pointed lower, and every bounce attempt has been contained below the 20-week moving average. That currently sits at 1534, which is the exact same level that we were just looking at on the rise that we saw back in March. So I think if we get a confirmed close over about that 15.5 level, I think it's starting to paint a picture both on the weekly and the daily charts that things have settled down and that GE is consolidated, and perhaps maybe at least for a period of time, we may see a little bit more of an extended intermediate term uptrend where if we do break above 15.5, I think there's a reasonable possibility we're going to head back up into the 18-19 range. So that was a long-winded, I'm not sure.
But mostly agreement. Come on now.
Yeah, mostly agreement. I'd like to see that confirmation above 1535, but I do agree things have definitely improved on GE recently.
Yeah, it's certainly right now really piquing my interest. And you can see that PPO on the weekly chart. I can guarantee the PMO looks very similar, meaning there's a buy signal that just came in too. So I think GE is actually looking a pretty good candidate.
Yeah, one thing I would say, just for those of you who aren't familiar with the PPO, I can't speak for the PMO, but the PPO is the percentage difference between your 12 and 26 week moving averages. And to get a minus, you could pull up a lot of charts, and you're not going to see too many minus 12.5% moves on a PPO, or plus 12.5% for that matter, but especially 12.5. It takes a lot of selling to get down there. So I always caution these PPO moves when you're moving up off of a really steep downtrend, because all it takes is just a little bit of sideways consolidation or a little bit of movement to the upside to make that PPO, start to look like we're gaining a lot of strength. I still want to see that price confirmation. I want to get that breakout above 1550.
All right. Well, I'm going to show you that chart real quickly too. A weekly chart, and then we'll get started on the 10 and 10. Here is that PMO. And, we don't get a lot of signal changes on it. Like I predicted, we have a buy signal here. You'll have to go into chart school. I can't sit here and explain how the PMO is calculated. But I think my dad was saying it's sort of a tortured MACD formula. But in any case, our weekly PMO doesn't shift very quickly. It's a very slow mover. So again, I think this looks like a pretty darn good opportunity. Maybe wait for that. Maybe I'd put my order in at 15, if we could see if it'll hold at 15. I don't know. We'll have to see. But
Okay.
and with that, since I do have the screen, let us go to today's 10 and 10. I have a few more to add while we were talking, so I'm going to do that, and then we can get started here. So our first one is going to be Johnson & Johnson. So I'm going to just have you do that since I don't have these all in here yet.
Okay. Let's take a look at Johnson & Johnson. I think we may have talked about this. I don't remember if it was 10 and 10, but I think we talked about there's a couple of areas on Johnson & Johnson. As I was mentioning earlier, you have to keep in mind, I'm looking at the market from a bullish perspective. If it turns out that I'm wrong, obviously a lot of the commentary is not going to pan out, but I believe the market is still in an uptrend, and therefore I believe most stocks are going to eventually follow suit. Now, Johnson & Johnson, I do not think is a great looking chart at this point, but it is improving. We had a breakdown below the prior close at about 124. I think the move back up above it is a good thing. Normally what you do is you break through support, and that becomes resistance, just like we saw a few days ago where we couldn't get through 124. Now, with these lows holding so far, we're moving back up above 124. So short term, I like what J&J is doing here. Move back through the 20-day is the next thing I would look for. But as I've mentioned many times, the sideways consolidation, you can see how many times this 20-day moving average has been false. These moves, these breaks above, don't hold. We go below, we go back above, we come back below. You kind of get the picture. So I think there's a couple of things here that I'd be looking for. I think ultimately what's going to turn out is we're going to trade in a range for a little while. I think 136 is going to be a key resistance area. That was a prior low. That's where a lot of selling took place in early February. That's where we failed on the reaction high. So I think we got a shot on J&J, especially if the market's strong, to make a run for 136. Beyond that, I'm going to withhold or reserve judgment and wait and see if we can get through. To the downside, my stop would be around 121. I think if you break below 121, I'd be careful. But in the meantime, that's the trading range I'd play on J&J.
Okay. Let's see, what is the most popular currently in the chat room? Because that will be number 2. Oh, Apple.
Yeah, it's hard not to like what's going on in Apple. Apple heading for that $1 trillion market cap mark. I'm not quite sure how much further it has to go, but probably not a whole lot, maybe 50 billion. But anyway, Apple, beautiful move up here, breaking out. Earnings, came out very strong. Never hurts when you got Warren Buffett on your side saying that Berkshire Hathaway is purchasing shares. All of that has translated into a lot of volume coming in and a breakout to an all-time high. I find it difficult to get bearish when I'm seeing action like this on the breakout with heavy volume and continuing movement. PPO looks good. Like I said, the breakout, very strong. Technology's outperforming. Pullback on Apple to 182.50, in my opinion, is a buy. I like Apple.
Okay. Let's see. The next one we'll give you will be, let's see, Blackstone Group, BX. I think of BX as the base exchange back from when I was in the Air Force.
It's been underperforming. I'm going to pull this one up on the relative chart here because, we've seen the asset managers moving lower. And of course, Blackstone's in this group. But we were trying to hold on to that February low. And you can see Blackstone really had no problems moving right through it to the downside. So as a result, what we've got is a stock that's been underperforming the asset managers for a while. And when you look at the asset managers for the last 2 or 3 months, they've been underperforming the S&P 500. So we got an underperforming stock in a group that is underperforming the S&P 500. It's really hard to make money or to outperform the benchmark when that's going on. So I think for me, what I want to see from Blackstone is we had what should have been pretty good support from that February low. We were holding it, and then we broke down below it on heavy volume. Look where our failures are coming in, right at about 32.5. Let's get through 32.5 and revisit this one. Until then, I'd look elsewhere.
All right. The next one we have is ESIO, Electroscientific. The person was wondering where would be a good entry.
All right, ESIO, I think they just reported earnings yesterday. I think that was this big move here. I like that false breakdown, by the way, below these prior lows and then coming all the way back up and holding. So I think the recent lows, I'd be careful if we closed back below about 1760. So let me mark that level in there as support. Right there, you can see that the lows that we had established back in early April, just below 18, we went back down, tested it, and it looked like on very heavy volume yesterday we were breaking down. And then we came back up, and now you can see higher highs going in. I think this one's going to make a run, excuse me, for the March high of around 2175. So for me, it's in a trading range. If I wasn't already in, I probably wouldn't do anything because I think you've got about equal risk to the downside as you do reward to the upside. But if I was in it, I'd hold it because I think you got a chance to run up in that 21 and a half area and maybe challenge that March high.
Okay. Let's see, our only stock requested from energy sector, EQT.
All right.
Yeah.
Go ahead.
Oh, exploration and production in the energy sector.
Okay. Not performing particularly well in that space, which is a little bothersome. I'm going to say that you've got major overhead resistance coming in about 53 and a half or so. That was the prior low back in late 2017, broke below it on increasing volume here in late January, early February, and notice the reaction highs back up here, testing that breakdown, not being able to get through. So I think in the short term, I like this volume and breakout above the recent high. Came back down a little bit below the 20. That would have bothered me, but we came right back up above it, which is good. I would be looking for this to begin the uptrend. So for me, I would not want to see another close back below the moving averages. So I would go ahead and highlight the moving averages as something to keep an eye on. And eventually what I want to see is a breakout with increasing volume. You got a stronger PPO starting to show some momentum to the upside. So let's hold the 20 and let's get a breakout through 53.50.
All right. See the next one, Robo, Global Robotics. Robo, like RoboCop.
All right, Robo.
Classic movie.
Yes, you don't need to get into that. But, I agree. Okay, this is another one. The Robo went down on an intraday basis below that prior low in February, but look at that hammer that printed. So that's probably triggering. There's a lot of folks looking at those intraday lows and probably had stops there. And this came back up, triggered those stops, held, and now been rising since. This is another one that I think if it is truly moving back to the upside and we're getting this, rise in the PPO, pull back to the 20-day. I don't want to hold it all the way back down to 39 and a half or 40. So I think the rising 20-day for me would be probably the key area to watch in the near term. But I do like the improvement here. I do like that reversal after a false breakdown. And the next key area of resistance that I see is just simply going to be that recent high. We have not been able to close above 43 in a while. So it looks to me like maybe the 20-day to the downside, 20-day moving average to the downside, and $43 to the upside. Let's see which one breaks first.
All righty. Let's see. The only biotech requested, Array Biopharma, ARRY. And it looks great on the RRG right now for the daily.
Yeah, I think that one may have had good earnings. Let me, I definitely have looked at this stock recently. Well, maybe it was a gap down with earnings. Yeah, it's starting to improve, but it does have overhead gap resistance. It's on this move back up. It is losing volume and it's getting closer to that gap resistance. So that would bother me a little bit. I want to see a breakthrough and I really prefer it on some heavy volume. Again, you're looking at a stock that has not been performing particularly well since the late January high. It's still quite a bit off of that high. So on a relative basis, not a great performer. I'm mostly concerned about gap resistance. If that was truly earnings gap down, which I'm pretty sure it was, we're getting a move back up, but it could just be a head fake as we get to that gap resistance. Let's get through the gap and that 50-day moving average, put some volume on the board, and then maybe we'll have something.
All righty. Let's see. The next one I'm going to give you is, wow, they just opened one nearby my house. I'm so excited. Del Taco, and the symbol is taco.
Yeah, anything's got taco in it, I'm bullish.
Right? Oh, I love Del Taco. I don't know if everybody has them or not, but it's a Southern California staple, like In-N-Out.
That is a staple in my dinner repertoire about once a week. So, yeah, I love tacos. But anyhow, getting back to the chart, I don't think too many analysts are asking me about my dining preferences. Big gap down here on very heavy volume and took out the prior low from back in November. I would even draw a second line right there because that's going to be a key level, the top of gap resistance. This is kind of a flipped chart. A lot of times what I like to see is a gap up and a continuing move to the upside. Here was a gap down and a continuing move to the downside on very heavy volume. That tail yesterday, I'm not a big fan of that. Looks like it went up, tested it, put it in a little bit of a shooting star candle, and now we're backing off a little bit from that. I love tacos. I'm not overly thrilled by the chart here. If we can get a close above, say, about 1190 and get some volume coming in, maybe we can fill this gap up to 1275. But until I get through, I certainly would not be trying to take a chance here because I think this is a key area where we could see a pivot and move back to the downside.
All right, let's see. And next is Fossil, FOSL.
Yeah, I think this is one stock that I wish I had held on to for a lot longer than I did. Beautiful move here to the upside. 3 white soldiers. That's a bullish candlestick pattern. I really like that. We made a big breakout above 17. This was one of those gaps where we had gapped up with earnings, pulled back, and literally that $11 area would have been great entry. I remember trading this when I did well with it, but I didn't hold on to it. I wish I had. But here was your breakout. There's your big volume. Pulled back, got close to the $11 level, not quite all the way down, started turning back up. And look at the volume coming in as it makes the breakout here, back above $17. I think to the downside now, you've got good price support at 17, and you've got the rising 20-day moving average, which is coming up very quickly now, and it is at 1541. That is the area of support that I see on Fossil. I like the stock. I really like this breakout, and I see this one going higher in time.
All right, and let's see, number 10, drum roll, please. It's going to be an industrial in delivery services, FedEx.
All right, FedEx, let's take a look. Well, there's not a whole lot in the industry, so that's probably relative chart's not going to work out too well here. 255 is, I think, a big level to the upside, and just below 230 is the key level to the downside. So I think FedEx right now is range bound. Very similar to Johnson & Johnson, just in that I'm bullish. So I'm looking for this to eventually break out and work its way at least to the top end of this range. But because I like the market, I think FedEx eventually goes for the ride to the upside. But in the meantime, currently, you look at the last 3 to 4 months, and definitely we are in this trading range. So a breakout, what you don't want to see is another one of these false breakouts above 255. That would be a short-term sell signal for me. Downside, you really want to see these tails go below the 230 level and a hold. That would be a buy. So I would just trade this trading range for now, but eventually I do believe FedEx goes higher.
All right, and that is 10 and, well, almost 10.
Maybe 12.
Yeah, maybe 12, 15. It doesn't matter. We do what we want. All right, ChartCon coming up. Oh, first we got to show you all those symbols we just talked about. Yes, I'm going to be putting these symbols up in the Chart Watchers, Market Watchers live chart list, and you can get to that. Just hit that blog articles tab, find the Market Watchers live blog, and the chart list that has all 10 of these are there with all of the annotations. You can save them, look at them, whatever you'd like to do. So I will have those up after the show. And with that, we have a very important website link you should look at, and that would be stockcharts.com/chartcon. And let's go ahead and look here. But our theme is going to be reducing risk in uncharted waters. And I know lots of questions on our surveys in the chat room, people wanting to know stop levels. Do you use mental stop? Do you use hard stops? Trading plans, like what I'm going to go over. And we have just a fine array of speakers that will be there, and they're going to all talk about this kind of thing. So I highly recommend you sign up for it. It is online. So you do not have to travel to get there. All you have to do is travel to your living room or your office or the park or wherever it is you go with your connected devices, and you'll be able to participate. And if you can't be there during the actual live broadcasting, you can watch the rerun later. I mean, you're going to have that. You will have that. Okay. And with that, I'm going to move into our final market update. And that will be, let's see, right over here. We'll just move into the member homepage. If I can get there, there we go. And let's take a peek. Well, you always can see the list here on the front with our market overview. But I'm going to take you to Candle Glance, and I think we have a little bit of time. I'll take you over to our market summary, see what industries are doing well right now. And as you can see, another pretty good day. I mean, we had a pretty decent rally, but we did slow down at the end of yesterday. But today, the market was ready to take off again, and you can see we've been in a very steady uptrend since this morning after the gap up for many of these indexes. Russell 2000 is continuing to do very well, seeing a little bit of deceleration on this rally right now, but not anything I would be overly concerned about. You can see that Treasury yields are down, currently reading at 2.96%, and we have UUP, big gap down this morning on UUP. Made a recovery, but is now falling back down. I wrote about the dollar yesterday, and my thought is, yes, great rally, but I think it's time for a pause. We've hit some interim overhead resistance, and so I'm looking for a little bit more of this sort of travel. You've got commodities that are mostly unchanged. Oil, USO, is down on the day. Currently, USO reading 1432. Gold gapped up and is now pretty much consolidating sideways. And we can see that the VIX, as we were talking about, continues to move lower. Look at the move over just the last 2 days to bring the VIX down. And looks like it wants to go up a little bit right now, but you're going to have some bumps in the road along the way. Let's go ahead. I'm going to go to our market summary. As I said, this is a perfect place to get the details on what's happening besides the major indexes and what they're doing. We can look at the sector spiders and make some comparisons. And all of our sector spiders are rising. Consumer discretionary is the laggard, but it's still up 0.4%, so I wouldn't be too concerned. Healthcare definitely having the best day, up almost 1.75%. U.S. industries, gold is leading the way. Semis and telecoms are your next big winners at the top. Retailers and networking, those are the two that are struggling today. But I guess, again, everything is up, everything is green. Retailers are the laggards, but they are not the losers. They are still rising. International ETFs, Malaysia, Brazil leading, Mexico, all of those up over 2.5%. And we can see that the only one in the negative right now is Italy, down about 0.5% for the Italy ETF. With that, I'm going to complete our final market update, and I guess it's time for our scooter reports.
Yep, take it away if you're ready.
Yeah, I can certainly do that. Typically what I do is I like to go into the scooters technical rankings right here, the stock charts technical rankings. We have plenty of different items you can select. In fact, there is my DP signal table, and show you right here. We just got that buy signal in the midterm, intermediate term trend model, first one to turn. And one of the reasons I'm getting more bullish is because we are starting to see those types of signals changing. But we're talking about scooters. And I want to look at small caps because we've had a lot of discussion about how they tend to do well. These are your top leaders. These are the scores themselves, and these are the top 10. You can see they're all over 99, meaning that in their small cap universe, that these are the strongest stocks out there. As I like to say, batting average. These guys have the highest batting average. They're not going to do well every single day, but they can hit those home runs and they can get on base regularly. I'm a sports girl. What can I say? So what I want to look at today, though, are these big movers that are having these really big changes, because a lot of times these big changes will come off of a scooter that's been basing. So you like to look for those ones that are taking a spike or a big move ahead. So what I'm going to do, you can of course hover over these and just see what's going on. And clearly we see a lot of gap ups, giant changes here. I'm going to go ahead. I want to go look at them in Candle Glance, and I'm actually going to switch over here so I can get my Candle Glance that I like to use. And there we go. We'll make them small caps, top up, and let's look at what's going on these Candle Glance charts. So, a lot of these have made these giant spiky moves, climactic moves, but some of them are just moving up out of, breakout range. So for example, I'm looking right here at gas star exploration, and that catches my eye immediately. I have rising PMO bottoms. You can see that they've been kind of on decline or flat for the price bottoms. Let's look at this one a little bit more closely. And I'm going to, excuse me, annotate a little bit here. Let me fix this. Like I said, for some reason in Safari it does that, gets blurry. Okay, so I'm going to use the trusty auto support line. I like to make it a little bit less opaque, so that's how I do that. But you can see pretty much bounded in a trading range, and we've finally broken out from there. And I've got that what I call a bull kiss. Got a fake out move, a head fake as it was coming down. We got that sell signal, but then it immediately turned back up on just a little bit of price momentum to the upside. So I thought that was very good. But here's that scooter. It just shot up over the last 2 days with those big rallies. But I like to see that breakout. You could see a reverse head and shoulders here set up, which means you should expect a move up. Now, granted, this is, we've got some liquidity here, but we're almost in penny stock range here. So certainly something to consider as far as your risk level is concerned. But interesting to see a breakout like that. So we're going to go back here and look at some others. There we go, small cap and top up. So I go to my Candle Glance, so I can see my PMO, I can see the time period, the 6-month time period I like. So here we go. Here's a few more to look at. You can see what are piquing my interest here with really seriously nice breakouts with a PMO that's setting up. Vivint Solar, I see that. I'm getting that move upward. It's not a penny stock, but we are talking about a lower price stock. I'm going to go ahead and annotate this one as well. And then I'm going to pass it back to you, Tom. Really nice breakout. Again, you can make a case for these reverse head and shoulders that are starting to show up. I've got that 50 just now back in late April. Went to a buy signal, the long-term trend model, that 50 crossed over the 200-day EMA. Love to see that. Puts this in a much better position for a breakout and a move higher. And I could very easily see you've got some levels here that would have to go through, but a move to $5, I don't think that's out of the question here. So something to look at. Again, these lower price stocks, just be aware that you might have some volatility to deal with there. And so those were the two small caps that I did. And remember, I found them simply by going to the dashboard, selecting scooters. I decided to look at small caps. And then I wanted to see which were the biggest movers right now and top up. And I clicked on that, made it my Candle Glance. And then, like I said, I've shown people, I think we've talked about how to make your own Candle Glance, but basically set up your chart style, save it as Candle Glance. And that's what you will always see when you go to your Candle Glance. So, and with that, Dom, I'm going to pass it back to you. And what do you see in those scooter reports?
All right, well, I will show you what I was going to look at today. Yeah, I use the scooter reports. I always go to this control center, and I'm also going to look at some of the small caps as well, because I do think that is an area that I don't know, maybe a lot of folks are overlooking. Everybody thinks about the Dow and the S&P 500, but as we've shown on here on the show, I mean, it's really the small caps that have been moving, and I believe the dollar is going to continue to rise. just because it's just started, in my opinion, to play catch up with what's been going on with Treasury yields. So I'm going to start first with the scooter reports here, and I'm going to pull up the small caps, and I'm going to go a different way. I'm going to actually go with the change down to take a look at some possibilities. So what I'm looking for are maybe scooters that are in the 55 to 70 area that are down. And then I also want to kind of keep an eye on the volume levels to make sure that the volume's okay. So for instance, here's a stock, Bold, Audentes Therapeutics, that has a scooter right now, 69.5. It's down 20 points. So it was a 90 scooter before today, and it's traded 608,000 shares. So I don't want to waste my time on some of these stocks. Like this one up here, you can see he's only got 17,000 shares. Chances are it's going to be an illiquid stock that I'm not interested in. So this, I think, is one to at least take a look at. Now, it doesn't mean I would be a buyer, but let's take a look at it. Bold, okay, well, it looks like it maybe is breaking down. Today's volume is much heavier than normal. It is in the biotech space. It got up to close to 41 at resistance, starting to roll back over. I don't know. I don't really see anything that's jumping off the page at me, but obviously it is pulling back on the chart, and that's kind of what I'm looking for. I want to see these pullbacks. Let's take a look. You know, I went through here and I pulled up a few of these. I was trying to find the first one, and I don't see it on the list. But I'm going to just give you the charts. Let me go over here and pull up Sienna. So these all came from that list I was just showing you. But I just don't want to go back and spend time looking for it. Sienna, and I'm going to pull it up in the relative chart style so we get an idea of maybe what the stock has been doing relative to its peers. Here's the telecommunications group breaking out to new highs. I love seeing that. Sienna has been pulling back. So on a relative basis, it's been weakening a little bit, but it had broken out. And I think that probably for me, this 0.021 area is going to be somewhat important because that's where we broke out from on a relative basis. So I'd be looking for Sienna to start to outperform pretty soon. Now, I don't like the candle so far today. So if we just go back to that daily chart for a second, I would, either like to see it put in some sort of an intraday low below the moving average and come back up and hold it, or just let it go for now and see maybe if you can get it all the way back down the top of gap support, which is where it has been holding. Another trip back down to 2460, 2470, I think could set up a really nice reward to risk trade on Sienna. So that's something I would keep in mind there. Now let's pull up IOSP. And I think this one might also be a little bit low on volume. Yeah, it's a little bit low on volume, but I like the chart. I like the fact that we had all this sideways consolidation. I believe that this was earnings. I'd have to confirm that, but a huge gap up on increasing volume. Now, again, this volume is not heavy enough for me. I wouldn't trade it, but I like when you get these gap ups with earnings and you go back and you fill the gap. A lot of times you'll see a stock make a move right back up toward the high. And I'll just show you Juniper. I know we've gone over this one in the past. Very similar, though. Huge gap up with earnings. You come back, you fill the gap, and then you start making this move to the upside. So it's those kinds of things that I'll look for, because I could put a stop in a little bit below gap support, either closing or an intraday, depending on your style. But let's take a look at a couple of other ones. First is FI. This is Frank's International. Now, I know we've talked about false breakouts and when to sell a stock. Take a look at this resistance level from mid-January. Look at yesterday on massive volume. We went up well above the $8 resistance area, but we failed to hold it, and we came back down and closed below. That, to me, is usually a short-term sell. And look at what's happening here today, down 5%. Now, I still like the chart. Actually, I think this move up, we've been holding the rising 20. Maybe it weakens enough where I can get all the way back down to that rising 20-day moving average. So I think this is a chart that looks really interesting. And if we compare it to if I put it on my relative charts, we can kind of see what's going on here. It is in the oil area. So as the oil group as a whole is much lower than it was a few months ago, you can see that Frank's International trying to make a breakout. So I actually view this to be some good relative strength. And that's what this is showing right now. So you've got small cap. Remember, many of the small cap stocks are doing better than some of the large cap stocks. And you had this downtrend that was in play, but the relative strength bottomed on FI versus its peers back at the beginning of, March? And then it also bottomed versus the S&P 500 at the same time. And we've been trending higher. So here's a stock that is starting to show a lot more relative strength. And we've got a major resistance level at $8 that we failed on yesterday. Now we can wait and try and get this on a breakout, or we can wait for a pullback and maybe get the rising 20-day moving average. But I think this is one that gives us an opportunity. And the last one I have, just do a real quick one on Wolverine Worldwide. This is in the footwear area. Check out footwear. It's been a pretty good performer, just kind of consolidating sideways. But WWW looks to me like it just broke this relative downtrend line with its earnings yesterday. Also versus the S&P, we had a sudden jump to the upside. And footwear overall, we've been pulling back recently, but this has been an uptrending group. So you got a stock, in my opinion, that just made a breakout above a recent high, and you're in a space that has been performing pretty well. I think that WWW is going to make a run for this 33.5 area and eventually make the breakout. So with that, why don't we get a quick recap on what we just discussed. And you've got Erin's stocks, the way she looked at it, going through the scooter reports all the way, kind of working its way down the scooter movers to the upside. And then the way I like to look at it in this particular case is, again, also following the small caps, but looking for weakening scooter, because I like to buy pullbacks. And a lot of times you're going to get those scooters that are moving up, the big movers, probably you'd be chasing if you get into many of those stocks. Some of them could just be breaking out. But I'd find it more valuable to look for some of these that look good but are pulling back with their scooter. So I gave you a little different flavor today there.
Yeah, you can use these reports, various ways. So, yeah, I mean, I like when they're high, because, like I said, I consider that a batting average. But at the same time, eventually they might have a slump. So then you've got to keep an eye out on that as well. So.
Yeah, I will say that today's action, in my opinion, is very bullish. It's been a move straight up almost all day long. This is what I refer to as a trend day, where the buyers are just completely in control. The one thing that could add to the bullishness would be a breakout on the Russell 2000 by the end of the day. We're sitting at 1607, and we need to get through about 1612. So with that, here's the poll for the day.
Yes, we were asking everybody about when they typically put their trades in. And I know this can be a little bit confusing when you're talking about time zones, et cetera, but mainly before lunch, after hours. And, most people don't do after hours. And I have to agree, that's really my least favorite time to put in a trade. But I typically am a morning person. I'm typically making my trades in the morning.
Yep, I mostly trade during the afternoon. I like to see what's going on. But anyhow, here's the upcoming schedule. I'll let you take it, Erin.
All right. Well, everything's stock charts will be coming up tomorrow. We have my workshop on Tuesday. I'm still taking requests in the survey responses below this viewer. Dan Russo will be here for a longer segment on Wednesday, followed by Julius DeKempener, Mr. RRG, on Thursday.
Thanks, everybody, for joining us today. Please remember to complete that survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. We'll see you back here tomorrow on Friday. Happy trading.